Welcome to TCA Crossroad, where investors and entrepreneurs connect. We have a very exciting episode today. We're going to be talking to an entrepreneur as well as an investor at Techos Angels by the name of Richa. And we're going to talk about how to deliver the perfect pitch. But before we get to that, I want to introduce you to my co-host, Costin Tuculescu. Costin?
And I also happen to be the entrepreneur, so that's great. Wearing two hats today. Hi, David. How you doing?
How you doing? What's new and exciting today?
Oh man, well, super pumped about the podcast. So this is episode 4 now, and we're trying to do these on a weekly basis. We drop them on Wednesdays, so everybody, make sure you're tuning in and
subscribe. Right. Subscribe, like, and share.
We're going to have all the buttons everywhere. Subscribe, like, share, send via email and all of the above. So that's cool. I don't know if you saw a few weeks ago, I hosted a ChatGPT generative AI meetup, and we hosted it here in Irvine, and we had about 70 people just show up randomly. And wow. it all just started on LinkedIn. And, it goes back to our episode 2, where we talked about the excitement of ChatGPT and generative AI. And it is real. It is alive and well in Orange County. And I'm excited to do more of those. So that's something that I'm excited. How about you, David? Anything new and exciting?
Well, we're seeing a lot more cooperation among different angel groups through syndication. But the other thing that we're seeing a lot of deals using AI in the medical space, either in diagnostic or in curative or in platforms, particularly relative to how do I find things that may not be evident. It's supplemental. I don't see any ChatGPT, being used there per se, but AI in predictive medicine, very big area. We're seeing a lot of that. We'd like to see even more of it. But as these technology trends are coming up, AI is kind of dominating, and so are the life sciences area. So you combine the two, and that's pretty powerful. So very exciting investment times.
Yeah, we are just at the beginning of an entire shift in culture and technology. And also, there is some magical AI happening with your chair, David. I don't know if you notice. I think the AI is making your chair appear and disappear into thin air.
Yeah, it's kind of... that's what unfortunately happens sometimes when, nothing is perfect, but I will try to figure out a way to cure it.
That AI needs some more a little more intelligence in the chair detection there. Probably. But hey, let's dive into today's topic. So today's topic is about perfecting the angel pitch. Obviously, this is for all of those entrepreneurs out there building companies, and you want to get in front of a group like Techos Angels, and you want to present to them, and you don't want to fall flat on your face, okay? You want to make it past the screenings, past the pre-screen, into the screening. You want to make it to the dinner, and you want to just rock their socks off. And we have an expert in the space today. We've got Richa. JJ, there you are. Hello. How you doing, buddy?
Hey, JJ.
Hello. How are you guys? That was pretty cool conversation. I think I got AI behind me too.
The chair AI,
it's contagious. Take 2 aspirin, call us in the morning.
There you go.
I'm really looking for a company to invest in that really perfects the chair detection AI. That's clearly a pain point in the industry. Well, and JJ, love that sunset behind you, and we can see you've got Pismo Ventures behind you. Why don't you tell us just a little bit about what Pismo Ventures is?
Well, Pismo Ventures is started about a little over 4 years ago. I'm as a technology entrepreneur, and I sat on both sides of the equation as a investor and as an entrepreneur. I started Pismo Ventures for the purpose of really helping startups with their startup needs. As you guys know, as much in me, maybe more than me, a lot of startups come to us, to Techos Angels and other investors, and they think they're always ready. They just want the money, and they just need a lead investor. That's all they need. That's it. And the rest is all easy. We give them the money and they become $1 billion company, but that's not the
All
case.
of them, 100% success rate, right?
100% success rate. So, Pismo is here to help entrepreneurs bridge that gap and really get them to be at a place where they are ready to pitch to investors and to raise capital. So we help them get there, and then we help them raise capital, and we invest in them as well.
And so I guess you've probably seen your fair share of angel pitches, investor pitches, and that's why you're the perfect guest today, JJ. So thank you for joining us. So where to start? I was thinking like maybe we just start with, what do you need to see in an angel pitch? Like what should be covered? Kind of like what are all the pieces that should be in the pitch?
Oh wow, it's I guess it's a hard question, but it's also a simple question at the same time, right? So it's the important part of it is that they need the entrepreneur, the founder must be confident of what they're doing. That's one very important part. Second is they need to have a team in place in order to be able to tell a story, and they need to have a story. So I could talk about maybe a little bit of the anatomy of what a pitch is all about,
Yeah.
and then we can dive into different areas as well.
So-
But at the very basic, oh, go ahead.
Yeah, so let's break it down into three components: the
Yeah.
start, middle, like a 3-act play. So at
Okay.
the start, what do you need? And at the middle, tell me the story, and then tell me how to get the conclusion to make the angel just say, "I'll give you my money."
Yeah, I mean, okay, so I think at the core of it, the most important thing is the objective of a pitch, regardless if it's a 3-minute pitch or a 20-minute pitch. It doesn't really matter. At the core is can you get these investors excited, interested, so they want to meet with you again? They want to potentially provide you with ask you for information, due diligence, etc. So that, or maybe a second meeting and a third meeting. So at the core of it, that's really the most important thing, is getting a second meeting or maybe additional questions to be asked. So tell us what the problem is. So it's very important. We want to know what problem you're trying to solve. And then second is, what is the solution? What is the proposed solution, right? So first is the problem, second is proposed solution. Third thing that I usually would like to hear is, how is it being solved today in the marketplace?
Yep.
Because it's really hard to understand, because sometimes as investors we come from different backgrounds, especially at Tecos Angels, for example. We have different companies from different backgrounds. I mean, different investors from different backgrounds. Some life science, some software, some marketing, some etc. And we want to know how this problem is being solved currently in the marketplace. So an example usually really helps. A real life example helps. And then tell us, how is the current solution that you're proposing is different than the solution that is currently in the marketplace. Is it better? Is it cheaper? Is it faster? Is it easier? There's so many ways to improve on a current solution. And so those are the first three things that we want to know, because what happens is, if the investor or the group as a whole doesn't understand within the first, let's say, 30 to 60 seconds, what is it that you're doing, then they're going to spend the rest of the time trying to figure out what you're doing, and then you lost them.
Yeah. And I want to hammer on there. Number one, the problem. Focus on the problem. How big is the problem? How meaningful is the problem? What does this problem cost to society? What does it cost to a consumer today? And then work the solution there. Awesome.
Yeah,
okay.
So what happens if there's a solution today, for a problem that everyone knows today? But what happens if the new business is trying to solve something that has not been done before. It's literally a new to the world product. And let's say there's a technical founder. Have you ever seen a technical founder kind of get stuck in the weeds, or is that just not a problem?
Oh, that's usually the biggest problem. Is you get a technical founder stuck in the weeds. They're the artisan, right? They know what they're doing, how to do something, and they spend most of the time talking about that product or that service or whatever they're trying to do, and they never really explain the real problem. They never explain the real solution. They never explain the real opportunity. They never explain the market demand. They never explain what's in it for the investor. So they get stuck in the weeds of this is a product and it's really great, and if I make it, if I build it, someone will buy it.
Field of Dreams.
Yeah, exactly.
And it's not just a problem for the pitch. It's also a problem if you do that as a business. You're just kind of building a cool widget because you think it's cool without really having validated the market. So the pitch is almost a reflection of the market. And if you can articulate the problem, a real world problem in your pitch, then you probably are onto something good with your business. Okay, so and then when you're talking about the solution of like why it's better than, like, give us a couple of examples of how you can articulate, like, are there metrics? Are there, like, how can we show that this is meaningfully better than what's already today?
So, I mean, in general, this is really depending on whatever the solution
The
may be.
specific thing. Okay.
It's
Yeah.
so specific, right? So, but it needs to be a meaningful solution. Meaning, we always talk about this, right? We always talk about is it a vitamin or is it really a cure, right? So
Aspirin.
is it an aspirin or a vitamin, or
Yeah.
so it needs to be a real solution that cures, or it has to be so much different to a point that I mentioned, is it better or is it cheaper, is it faster, is it easier, right? So it has to be uh, so much different that it's clearly a different solution that provides real value to the customer. Sometimes what we talk about all the time, and I see it all the time, is sometimes uh, we get founders that talk only about a cheaper solution, and that's usually not really a great solution, because it's just the economics, unless it's really something is $1,000 and they can produce it for $1. That's a huge difference. But most of the time we see it where it's cheaper, but it's not that much cheaper, and
Yeah.
then you cannot really compete that much on pricing. So there has to be other values associated with that solution, other than just being at a better price. It needs to provide real value for the customer.
Yeah, I want to throw this out there. There's like a metric in the startup world, and I think this might have even been in Peter Thiel's 0 to 1 book.
Yeah.
It's you got to be 10 times better, 10 times more value. Your solution has to have 10 times more value than what's already in the market. So 10x by
At the
maybe
very least, yes, I agree.
something like that. And that's again for the billion-dollar companies, the venture fundable companies. Okay. So now that we've talked about how to articulate the value of the solution, and it has to be maybe close to 10x better than what's in the market, what else do we need in the pitch?
Now you need to start talking about really how big is the market, how big is the opportunity. I mean, if it's a really tiny small market, I mean, maybe I should step back a little bit. The As investors, um, what's really important for us is we're looking for companies that could scale rapidly. So these are highly scalable companies that we're looking to invest in. And also, our objective is that these companies will eventually have an exit. Someone will acquire them, or there's an IPO or whatever it may be. But there's got to be an exit. So in order to be able to have a company that is highly scalable, and potentially have an exit, there's got to be a market that's big enough in order to be able to reach at least that goal. And
Yeah.
so if the market is only a 10 million, for example, it's not big enough. It may not be big enough to be able to excite investors. So the entrepreneur, the founder, needs now to talk about the market and how big it is. And everybody knows what a TAM, SAM, SOM is. So it is important to understand the TAM, the SAM, and the SOM. But most importantly for investors, it is really the SOM, which is a serviceable, obtainable market. So, and that is, can you reach as a company? Are you able to get within 3 to 5 years to a certain revenue that excites investors? And so that's really important. So it's the market that they need to talk about, how big it is, and then associated with that is the product market fit, and how are you going to get to the customers? Is it through partnerships, through channels? Is it internal sales, knocking on doors, uh, whatever it may be? So it's the market, the product fit for that market, and then how are you going to reach that customer?
So let me just step back and put it in context. What
Yeah.
you really talked about are two different things. There is the problem in the, well, three things. There's a problem in the solution, okay, which sets up the best rest of the conversation. Then you divide it literally into the business aspect with its metrics and traction, and then there's the investability part. Why is it so important for the entrepreneur to understand that a business may be good for a lifestyle, but not good for the angel? And why does that entrepreneur have to understand the end game that the angel wants to be in? Because we have so many failures and we need to have a certain return. Can you give some granularity or perspective on it?
And just short answers, because we'll probably have a whole different episode on the angel investment model, and I still want to get to the specifics for the entrepreneur, make sure they nail their pitch.
Yeah. So in a nutshell, David already kind of said it. So in a nutshell, it is, our objective as investors is because 90+% of the companies fail, is we were looking for at least 10 times our investment in a certain period of time, usually 3 to 5 years. I think the last time I looked at the life of a company before they exit, it's an average of 7 years. So a 7 year, and everybody talks, oh, we'll have it, we'll exit in 3 years, we'll exit in, but most of the time it's 7+ years. And some of the companies that have become very successful at TCA, they were in the 9 to 11 years average. And so it's been, and I know we have very detailed statistics on that, but what's really important is that we are looking for a specific return on investment, and it is multiple. We don't look for dividends or maybe percent. We're looking for multiples, and that's why it's really important that the founders understand that they need to be highly scalable to a point that investors are getting some return. And then also that's why we can talk about valuations as well. These have become really important. So we get to a point where you want me to slow down and
No, let's reel it back in. Let's reel it back in, because I'm trying to get to a point where we have a simple blueprint for a pitch, right?
Okay. So back to the pitch.
Back to the pitch. So we talked about first problem, then solution, then how our solution works, why it's better, and then you went to how big's the market, aka opportunity, and then you started talking about product market fit and go to market, right? Which have to be part of the pitch. But let's go a little bit deeper as to what you would like to see regarding product market fit in the perfect angel pitch.
Well, I guess it has to be, they have to have a proof that there is a demand for such product or service, and that's really what product market fit is, right? So can do they have a proof? Have they done market research? Do they have any traction? Do they have any sales? Do they have any customers? So that would tell us very specifically if there is such demand. We might, like we talked about earlier, we might think there is a demand, or they are definitely believe as artisans that if they build it, someone will buy it. But again, we use the word, will the dog eat the dog food? We want to know if that's the case. So the more they
And give
bring
us
to
the
the table.
examples of, like, what are your examples of product market fit? So revenue is probably the best. You got money coming in.
So the attraction could be defined in many different ways, right? It could be a revenue. It could be customers that are willing to use that product. Maybe they're still not charging for it, and now you try to take it away from these customers. They're not going to give it up. It could be other ways where they show that there is demand, but revenue and customer use of the product is really would be
Yeah.
the highest. um, but it depends. If you have a life science solution, that's a completely different model. But if you have a software product, or if you have a service, um, then it's really easy to prove to your investors what the traction is.
That's
What
excellent.
happens if you do have a life sciences thing? I know you're running a life sciences symposium or contest in middle of June. What would you hear differently in life sciences versus a SaaS or technology company? How do they
So
present it? Because the time frame is so much longer.
yeah, with life science companies, yeah, as you know, because most of the time they need FDA approval, they need a lot of money in order to get to the point where they could prove that it's working. So most of the time, they need to actually prove that the science works. So there may not be really, in a situation like this, ability for them to actually prove that there is attraction, because there is no customer yet. So it's really hard for a life science company to prove traction. So most of the time, for a life science company, they need to concentrate on the science itself. And that's why for life science specific companies, we you see them not commercialize the product. So we don't see them really talk about dollar and revenue and break even in a certain period of time. We look specifically more at their regulatory journey and where they're at, and
Mhm.
how much
Yep.
they've spent on getting from one place to the next. So that becomes much more important for a life science company than other type companies that have an actual tangible product or software.
So to just summarize this product market fit part of the pitch, if it's a software or product company, we want to see, number one, revenue. That's the proof in the pudding. Someone's paying you money to use it, and we want to see growth in the revenue. That's even better.
That's
And
right.
then usage and repeat usage. And, like, I come from the product management world, retention, right? People coming back.
Retention.
And
They may
using.
not have, even if they're early, they may not know what, again, they
Yeah,
may not
yeah,
know what the LTV is, the lifetime value is. They may not know yet what the customer acquisition cost may be. So some of it may be too early, but it could be like we always talk about, companies that provide a free service, right? A freemium type service.
yeah,
So that becomes important. If they provide a freemium service, how many customers are coming
using.
to use that
Yeah,
service or that product.
yeah,
But then sometimes what you turn on the money and then they leave, right? so
yeah,
so
yeah.
it's important to really know how much they're willing to pay as well, because at the end of the day, you're looking for revenue.
I think what entrepreneurs need to articulate is the amount of value that their customers are getting, even if it's a free service. How do you translate that to value? And when people come back and they use your product every single day, that means they're obviously getting value. So again, usage, retention, dollars on the product side, and then on the life sciences side, it looks like evolution in the science itself, or through the regulatory track to show that they're making consistent progress, and that should be their product market fit and traction slide, right?
That's right.
Also, don't forget partnerships in the life sciences area, especially if you're developing a test or or a molecule. You want to see who their affinity partners are. If they're working with somebody else, they're working with Dr. Reddy, or they're working with Amgen, or they're working with Genentech, or somebody like that. So the point is, there is some mechanism for traction, right, JJ?
Yeah, that is also what becomes really important for life science specifically, is potentially who is going to buy this company, the acquisition partner.
Yep.
Because let's say, for example, especially again, they're not going to commercialize in general. So who would have a huge market presence with an infrastructure like Medtronics? Someone would have that infrastructure. Then they would start talking to them in order to be able to understand if they would be interested in something like this. And if you have a partner like this in the marketplace, they're going to let you do all the hard work until you get to a point where now it's ready to be commercialized, and they can commercialize it much easier because they have the infrastructure in place.
Yeah. I don't want to blur the lines for our listeners, so we kind of went from product market fit into go-to-market strategy. So your partnerships are pretty much your go-to-market strategy, and then we even dipped our toe into the conversation about the exit, which is also a slide or a conversation that needs to be in the pitch. So let's just go back just 1 minute and talk about go-to-market slide, right? Like, we need to have a conversation about, we've demonstrated go-to-market, we've demonstrated product market fit with some kind of traction. Now, this is how we're going to scale, right? And maybe talk a little bit about how to articulate that in a pitch.
So, okay, so let's talk about go-to-market strategy. So let's talk about first an easy one, and that is, if you are a life science company, most of the time you're not going to have a go-to-market strategy, except finding a partner, finding other big companies. Again, you might, but the likelihood of going to market on your own and commercializing is going to be very difficult. Well, it's not only just difficult, but also demanding a huge amounts of dollars, in the tens of millions, potentially hundreds of millions of dollars to get there. And most companies cannot get to a point where they're able to continuously raise in order to get there. So for the non-life science companies, the go-to-market strategy, again, there are many ways of doing it. So, you have to understand your market first. Are you going after, moms that are between 25 and 35? If you know that's your market, that's your target market, then you have to figure out the best way to reach moms that are within that age range. How do you do that? There are ways, a lot of times we hear, oh, I'll go and find some influencers that do this. Well, that's great, but influencers don't sell. Influencers potentially provide some marketing, some influence. Exactly. So there's got to be. This is a particular point that I always, when I'm listening to pitches, it's important for me, because most of the time we hear people talk about, oh, I'll have an internal sales team and they're going to, kill it. And that's usually one of the hardest ways of reaching your customers. We want to hear about the easiest way to get to your customer, where the customer acquisition cost is at the lowest possible. So how do you get there? Could be channel partners. How do you get there? Could be creating a network of providers that are making money from the same solution that you're trying to sell, that product or that service. So there are many ways where you're not spending so much money building an internal sales teams, or going knocking on doors one by one in order to reach that customer that you're trying to reach. So what I mean, again, it's different for every solution, but the go to market strategy has to be where your ultimate objective is your customer acquisition cost is the lowest possible.
And I love that you said that, because I was going to take it there. So the pitch requires articulation of how you will get to market, but the investors wants to see that you've been thoughtful as to the most efficient way to get to market, where it's like your lowest CAC, not where you're paying $120 per customer to Google, but maybe where you've taken advantage of an affiliate program or a channel where now you're getting customers for $5 per customer.
I think absolutely the ultimate objective, no matter what, is to make sure that the CAC, the customer acquisition cost, is the most efficient. It doesn't matter how you get there, but that has to be, a lot of research must be placed on that in order to get to your customer with most efficient way possible.
I love that. Okay. So we're making our way.
So
Go
let
ahead, David.
me flip it around a little, because you talked about, you have all the elements of a pitch. You know the story, from product market fit to size of market to your finances, your metrics, your exit. But all of this has to be pulled together by a team of people, because one of the things that we know as investors is that the team, and especially the CEO, becomes the most critical element, other than just plain luck, in making this a successful venture. So talk about the team, and particularly how you use advisory boards to try to help you generate the interest, either for a startup life sciences or a company going to market as a SaaS company.
Yep. So so that was going to be potentially next. I was gonna talk about the
See, I'm very smart. I knew that was the next part there, because Costin told me.
You jumped to the punchline, David.
I jumped the shark there.
But after go to market and exit, is that where you would put it, JJ?
I was gonna go for competition next. But we'll talk about the team, because sometimes you can talk about the team at the very start of a pitch. I love that. I think it's important too, especially if the team is stellar, if they've had an exit before.
So if Elon Musk were part of that team, I'd probably start off with the team, and then the other stuff is all what it is.
You just need one slide.
Yeah, one slide. Elon Musk.
Right?
Yeah, and you don't even have to say anything after that, right?
That's it. That's a pitch. That's good.
So most of the time, when the team slide, when we see team slides, they just run over real quick and okay. So, but the team is more important than anything else, because we really invest in people. We invest in teams more than we invest in the actual idea or the actual opportunity. I've been actually, I mean, David and I have been doing this for about 15 years now, and I've changed a little bit my strategy. Like when we get opportunities that come our way, when I get opportunities that come my way, I regardless of how great it is, if I don't believe in the team, I'm willing to pass, because there are a lot of opportunities out there, and sometimes if they try to sell me or oversell me on the opportunity, and they're saying, "Oh, you're gonna miss out," and I'll say, "No, it's okay. I'm okay missing out. It's fine." So there's so many opportunities out there that the most important thing is really looking at the team. When you look at the team, what do you look at? The first thing that I look at is, do they have expertise in the market? Do they have expertise in this product or in this service? It may be adjacent, that's okay, but they need to have some expertise. They need to be able to um, tap into their network of people that they know, that they could that could open doors for them. If you are a Xerox salesman, that's all you did all your life, and then now you're trying to start a life science company, or you're doing a software product, and you don't know anything about software for some B2B business, whatever it may be, whatever industry it may be, it's going to be very hard to learn the entire journey of that specific industry, in order to be able to start understanding how to talk their language, how to. So you have to have knowledge, expertise in.
But if it's printer or copier management software, then you might just be the perfect person for
you,
that,
you
right?
might you might do that. That's right.
Yeah.
But if you're changing, if you're going into aerospace, that may not be the right thing, right?
Yeah. Yeah.
So anyways, it is really important that they must have industry knowledge, industry expertise. Second is, they need to be able to, well, they don't have to have, we always talk about, if you have a previous exit, it's really great. But if you if you've done this, if you've done this for a long time, you understand the industry. And so it's important that they have a full team, including someone who does sales, someone who does marketing, someone who is a CFO. The financial piece is really important, and someone who's a CEO, at least, that understands how to take or how to lead this business. But you need the sales, you need the marketing, you need the finance, and you need the CEO leadership. Without, at least at the very core, these pieces, it's really hard to be able to believe in a team that's going to take the company to the next level. I'll add a couple of things. One that's really important, that I look at when the team is pitching, is how coachable are they? And you could tell, again, when you do this for a while, you could tell right away if someone is potentially coachable, or they're stuck in their own ways. And the reason I look at this is because you have to get to a point where, because business is not a straight line, they need to be able to change course. We use the word pivot. They need to be able to pivot, because it's not a straight line. They may have a plan, it may be perfect, and it may be perfect today, but COVID hits. What are you going to do? You could just instantaneously die as a business, or you pivot around it, you find another way to be able to use that product, that service, in order to continue.
The, there's the great saying by the great Michael Tyson that says
Yeah,
everybody's got a plan until you get punched in the face. I love that. And thank you, JJ. I mean, proportionally, I think you spent most of the time of this podcast on the team, which is appropriate because you believe that it is the most important part of the venture, right?
absolutely.
So for the team, you've outlined a number of great things. You want to see a robust team there. Let's quickly go through what else might be missing from the perfect pitch. What else do we want to make sure we nail in our pitch here?
I think he needs to talk about what you want to see in a deal or deal structure. Do you want to see safe notes, convertible, preferred, ask? What's the what that would seem to be the most appropriate thing to that's needed, right?
Yeah, I think that, again, before we go there, is really, I want to hear about the competition. It's
Mm-hmm.
really important that we know who else is in the marketplace, who is doing this, and how they're doing it. And it's really important that we see, either some kind of a table, or some kind of a graph, or something that tells us how is this product or service different than how the competition is currently selling it in the marketplace. And again, back to the value. How much value is it? Is it 10 times? Is it 15? Is it 100 times more value? And how you're doing it. If the differentiation from other competitors who may be much bigger as far as revenue, or they've been around for a long time, if the value is not that much different, or you're adding only small features that they can add, and they could do this very quickly, then really you're not adding so much value. So we want to know who your competitors are. Are they really huge conglomerates, or are they other smaller? And also it relates to how big the market is as well. So not to confuse a lot of things, but it is connected to how big the market is and who that competitor is. If the competitor is someone like Google, and then you're adding a feature to a mail service that does something, Google will probably be able to do it in a couple of hours with having 10,000 engineers there doing it. So so there's got to be something that's really different, or maybe at a calendar system, which I heard that a few days ago. Someone is coming up with a whole new way of doing this. So
Did you fund them? Did you write a check?
not really.
Okay.
So the competition is really important, and again, sometimes you see people putting these quadrants, right, and they put themselves in a completely
Top
separate
right,
quadrant,
top
right?
right, always,
Up right
always in
all
the
the
top
time.
right.
There has to be a reason why you're there. If everybody is in the other quadrants, something else is it needs to be shown or proven to show us that you are in that quadrant. So
Got it.
competition is huge.
So that's key to, and it also shows the entrepreneur's understanding of the landscape and what they're getting themselves into, right?
That's
So
well, it shows us that they've done research, and
yeah,
that's really huge.
yeah,
Yeah.
perfect, perfect. All right,
So,
so
let me jump into one more thing that's really important, because before we go to the terms, I guess, how are you going to make money is also important,
business model, yeah,
right? What's your business model? So is your business model, is it a one-time sale, or is it reoccurring sales? Is it a subscription model? Whatever that may be is really important. But also your margins. How much money are you making? And sometimes we see 30%, 40% margin. For a fast growing company, highly scalable company, you need a bigger margin, or because you're going to need more money in order to be able to stay ahead of the curve. So you need a lot more, you need a bigger margin in order to be able to stay ahead of your competition. So we need to know the business model, which then correlates to how long is your sales as well. Because if your sales cycle is a year and a half, 2 years, then that tells a different story, and that is, you're going to need a lot more cash in order to, uh, you know, sustain operations, in order to get to a point where you are able to make that sale.
yeah,
And now what, and also depending how big that sale is, do you need the money in order to make that product? And so there's a bigger story there as well. That's why I'm going to jump to something else, and that is your financial projections. And
yes,
so what does that tell us? It tells us the most important thing, absolutely, from my perspective, when it comes to financial projections, is really the assumptions that you're using for your financial projections. Because anybody could write any numbers on the screen, and but the most important thing is, tell us what your assumptions are, uh, that got you to get to a point where you could show us these numbers. So these assumptions helps us understand where you're coming from, and how the numbers came about. And um, this is where you need a CFO. You cannot do something like this without doing a lot of research and having someone who's financially savvy to be able to put these together. Show us how long you're going to get, when you're going to get to a break even. and then don't show a hockey stick of $1 billion in 3 years. It's not going to happen. It's never going to happen. No one's ever done it. Have you seen any company?
Billion in revenue in 3 years? Probably not. No, I'm not seeing it.
No.
We'll see though where OpenAI gets. If we count November, if we say they launched, I mean they've been around for 7 years, but they put their first product out in a big way in November of 22. And they jumped to 100 million users, and I know I'm paying $20 a month for GPT Plus. So we'll see how quickly they get to that $1 billion mark.
That's by the way, that's an example of traction. 100 million users not paying, right? That's traction.
That's right. So we covered a lot here. Did we get it all, JJ?
No, we still need to talk about the deal, because
the deal.
You can tell everything you want. You can share, here's the business and here's the traction and here's the team. But, it's like you got to ask for the money. It's just you're in a sales process.
Yes.
And you're selling to the angel investor. Yourself as the CEO and the team, that you can deliver results that will enable the investor to get that kind of return. So in short form, it's a little more complicated, but what do you want to do in asking for the ask and valuation?
So let's talk about that quickly. So there are many ways of asking for money. The most important is really, what are the terms? So the terms include several factors. One is the valuation of the company, which means, what do you value the company in dollars today? And that's really important for investors. Second is, are the investors buying a direct? Is it a price round, which means they're buying stock in the company, and is it preferred or common? And then, or is it a convertible note, which means a loan that converts into equity after a certain period of time? Or is it what's called a SAFE, which is generated by Y Combinator a while back? And then another one that we know about, it's not being used that often, which is called KISS, KISS as well. So,
what is that?
Oh, you haven't heard of that one?
I haven't heard of the KISS.
Yeah, it's KISS. I don't remember the actual
Keep it simple.
Well,
it's a simple, basically, I owe you money.
Right, okay. Exactly. I owe you money. Pay me later.
I like that. Yeah, I like that. Okay.
So most investors, professional investors, really would prefer a price round, which is basically you're buying stock, most of the time preferred stock into the company, not common. So that's one. We're seeing a lot of SAFE in the marketplace now. It's changed recently from, there's version 1 versus 1.2, or I don't know what version it is, but the difference between the first version and second version is that first version was based on pre-money valuation for the company, and the second version of the SAFE is based on post-money valuation. We can go into a lot.
Let's keep it to just what he's
not going to do that. Yes, we're not going to do that. It's a completely different meeting on that one. So what are we looking for? We need to know what the terms. In a convertible note or a SAFE, we need to know how long is that. Is it a long term or is it a short term bridge? So a bridge is 3 to 9 months on average for a SAFE or a convertible note. A long term is usually over that, maybe up to 3 years. I've seen much longer than that, but investors don't want to see really that long. 3 years is really long already.
Yeah.
And then we're looking for a discount, and that is after it converts. Will the early stage investor that really took a risk, will they get a discount on the conversion? And then also an interest. So there's interest because it is a loan associated with that. On the direct price rounds, or then we're looking for either preferred or common, and so usually investors are looking for preferred, not common. And preferred, basically, the investors get their money out first common, they get their money out along with the founders. And then in the preferred, I'll add one more piece. There's usually a preferred multiple, right? So it's 1 times or 2 times, and some, most of the time it's investors are looking for at least 1 time preferred, maybe 1 time plus. So
and that means that they get their money back plus the same amount of money. So you've immediately doubled your investment, and then you participate. You usually convert to common and participate in a pro rata.
Sometimes participation, sometimes no participation. Yes, as well.
Yeah. So this is a world of knowledge. This is a world of knowledge, JJ.
I'll add one more thing that's really important here, because this is where we're talking about the valuation specifically that we started touching upon very early on in our conversation today. And this is where, if somebody has a very high valuation and the investor is looking for a goal of 10 times, if most companies exit at $100 to $150 million on average, you come to an angel group or a professional investor and you're saying, my company is valued at 30 million, and you're going to exit at 100, they're not going to get 10 times. So that's why we're always looking for maybe 5 to 10 million on average for early stage. Different stages have different objectives, goals, etc. But for early stage, that's the types of investors looking for these types of exits.
Yeah, that JJ, like this is like a crash course in how to get your company up and running, and incredibly valuable. So I'm going to do this. I want to do a couple of things. I'm going to run down the list of what needs to be covered. We'll do that. And then I still want to hear a little bit more from you. So even though this episode is running long, I think there's so much value here that I want everybody to just stick around. Okay. So we're going to, the pitch needs to have the problem, the solution, why your solution's better, and ideally 10 times better than anything that's there today. How big's the market? What's your traction? What's your product market fit? Then how are you going to go to market? How are you going to scale sales? How are you going to get your customers? What's the competition? How do you make money? That's your business model, right? And I'm going to put the financial projections after that. How much money are you going to make, say, in the next 3 to 5 years? What are your exit opportunities? Okay, so now we're at 10 slides to the story. Then maybe you put the team at the beginning if you got Elon Musk on your team, or maybe you put it as slide 11 over here. You got your team slide, and you say why this is the team for this company, going to create a unicorn. And then you probably want to have your ask and what the deal is, and this is the deal structure. Yeah. So about 12
That's
slides.
Right. I think one more thing we forgot to talk about. Again, there's so much. Is really advisory board and advisory team and board. Companies should have a board, even when they get started.
Advisory board or actual fiduciary director? Both.
Both.
Yeah.
They should have both. A fiduciary board of directors, at least 3 board seats, maybe more, but 3 to 5 board seats, and then again, of the board seats need to be filled by experts in the field that can really help, that understand, that really provide real value. The same thing with an advisory, a board of advisory, which is would you provide them also with a little bit of equity, but they don't have any fiduciary duty when it comes to the company.
Now, if you're a pre-seed or a seed company and you're coming to TCA, in a lot of cases, TCA wants to take a board, right? And if you have your governance is 3 board members, you're going to have the CEO, you might have a COO or co-founder, and then probably someone TCA or an angel will fill that 3rd seat. Is it worth going to 5 to bring on some experts?
It's really, it is very much worth going to 5 to bring experts to the table.
What you really need is you need the expertise on the board, depending on the problem you're trying to solve. If you're in a life sciences business, you want the doctors to be able to, or the the clinicians to be able to introduce you to other people to get those partnerships and to get the trials done. You may need a regulatory person versus on a SaaS thing, you need a CTO and a finance person, potentially maybe a marketing. So it varies. The boards will vary, but you complement the board of directors with an advisory board.
That's true.
Right. So we can
and you have to feed them with equity.
Right.
Yep.
Exactly right. And we'll still put that on the team slide probably. You got
That's
a great
right.
board, put it on the team slide. So we've got 12 slides that we're
You
talking
can
about.
put Elon Musk on the board too, and that's it. You're done.
Done. Okay, I'm gonna think about that. Now, so we just talked about kind of like what needs to be in the pitch, how to make a great pitch. I want to hear from you, JJ. What have been some amazing pitches that have blown you away? What's the stand? Let's say, you know, you're going to see some great pitches. They're all going to have this. What are the ones that stand out and just knock people's socks off?
Okay, so I'll mention one that happened a while back, and it's not really how great the pitch is. It's how great the opening part of it was. And it wasn't a good business, and you'll know why.
Good pitch, bad business.
Yeah, good pitch, bad business, exactly. But part of the things that we didn't talk about is really using an analogy to actually help your investor understand what you're doing. And so the opening of this pitch was absolutely fantastic. I knew exactly what they're doing in the first 5 seconds, right, or less. So this guy said, "We are to women's shoes what Netflix is to DVDs." That was when Netflix was doing DVDs. So I knew exactly what they're doing, right?
So that's good. So that relates to a really good elevator pitch to put on good context.
That's right. So basically, Netflix used to ship 3 DVDs. You use them, you ship them back. So what this guy is doing is shipping shoes to women that they chose, and then they ship them back. So I asked my wife, "Would you ever do that?" She said, "No, never." So the fact here is it's probably not a good business. There are other ways. I've seen people doing it with purses and maybe jewelry, other things.
But the takeaway is a metaphor is a
metaphor,
powerful
analogy. Yep.
Analogy for storytelling there. So, okay, you want to see a powerful analogy, metaphor that works. What else? Give us one more tip, and then we'll wrap up.
I think one thing that's really important that we didn't talk about, we have to talk about, and not really about a pitch, but it's really about you're sitting in front, or you're pitching in front of a bunch of strangers you don't know, right? So at the end of the day, you need to be able to convince these strangers to give you money. So how are you going to do that, right? So one way of doing it is, before you come and pitch to a full group of investors, is really build your network. Start talking to investors, start having maybe a coffee with them, start building. It's not going to happen overnight. You need to build the relationships. You need to start going to networking events. You see David, we see you, Costin, they see me, they see other members of Tecos Angels. We start introducing them to more people, and we start understanding who they are. And the more we understand who the entrepreneur, the founder is, the easier for us to be able to give them money when it comes to them asking money, as long as they, of course, they hit all these other things we talked about, which is a village by itself. So, but build that trust relationship. It's really important.
Got it. No cold calling for investor money. You got to warm up your leads, entrepreneurs. Okay. Everything is sales in the world. Everything is sales. Okay.
It's relationship. Awesome. It's people at the end of the day. People.
It is relationships and all that. JJ, this was tremendous. This was.
I know you're just saying that because we're on live now, so.
We're not live. There's no audience here.
Oh, you're gonna edit this one out.
Yeah. Well, I've got a lot of work ahead of me. This is already an hour. We'll see how much I can edit down. But no, I really think the the content here is enough to get a new entrepreneur up and running, and I think super, super helpful. So let's wrap up here. David, do you want to say, give us a little wrap up?
Yeah. So when you think about this, when you're an entrepreneur and you're doing pitching, you start with the context. Just like JJ said at the end, he has something that's memorable with the Netflix and the shoe, relationship. Context is really important, so you don't look at each other, because we sit there as angels saying, "What are they talking about? What are they talking about?" If we don't know, we tune out. But with the context in place, then you tell the story, which has a variety of different elements, as Costin and JJ pointed out. But in the end, when it really gets down to is the entrepreneur needs to make a case for the business and needs to make a case for investability, because we look at the end result. And the way to put those two together is a really solid team. And when you have that solid team, you have the higher potential for a successful business and a successful exit. And then we rinse, wash, repeat. JJ, thank you very much. Really appreciate it. I know it's a lot of good advice. It's like drinking from a fire hose.
We could talk for another hour. I know we can.
For sure. And I'm going to try to get some snippets and put those out there for entrepreneurs, because there's just lots of good stuff. JJ, thank you so much. David, thank you. This has been another episode of TCA Crossroads. Subscribe, like, watch, share with your friends. Thank you. Take care. Bye-bye.
Take care. David. Bye-bye.